Good day, ladies and gentlemen. Welcome to episode 5 of the Agorfomo Trading Podcast. On today's episode, I'm joined by a friend, equity analyst from CTA Research, Kevin. Thank you so much, Kevin, for joining me. Look, for the past few days, macros have been definitely driving the markets. Over the past weekend, I think we did discuss the NFP number, which came in so strong. And then also on Tuesday, we got inflation data, which was CPI, came in, the forecast was 4.2%. It came in at 4.2%. Yes, that didn't beat the forecasted number. However, it's still an uptick move from the previous CPI number, which was at 3.8%. So even though we did not beat expectation in terms of in terms of CPI or inflation, but that signals a continuous pressure in the economy. So, Kevin, I just want you to give me your take on these numbers. What's the Fed's next move? And fortunately, a new Fed chair is coming through. Also, what are the likely impact on the equity market? Just give me a brief explanation, and what do you think?
Thanks for having me back, Mr. Prayer. It's great to be chatting with you again. You are completely right. Macro numbers are absolutely running the show right now. When we look at that strong jobs report from the weekend combined with Tuesday's inflation reading, it paints a very specific high-pressure picture. Even though the inflation number matched what the market expected at 4.2%, the critical detail is that it moved up from the previous 3.8%. That tells us inflation isn't cooling down, it's actually starting to rise again. And we actually mapped out this entire interest rate path and inflation forecast on our daily news page over at ctaresearch.africa/#news, right when the data dropped. For the Federal Reserve, this essentially locks them into a corner. A strong jobs market gives them the excuse to keep interest rates higher for longer, and rising inflation means they simply cannot afford to cut rates anytime soon. In fact, because the US economy is showing such strong fundamentals, it puts the talk of a potential interest rate hike back on the table. For the stock market, this is a tough pill to swallow. Stocks generally hate high interest rates because it makes borrowing money way more expensive for companies and hurts their overall valuations. Since the markets had previously hoped for quick rate cuts, these hot macro numbers alongside big funds bracing for higher interest rates are forcing a painful reset across global stock exchanges. It's exactly why we are seeing stock prices hit the brakes hard right now.
After CPI release, we saw gold moving lower. At the time of the recording, gold was trading close to $4,013. Kevin, sorry. Does the pullback create an opportunity for gold traders or gold investors to start accumulating long-term position on gold? And specifically for our listeners to start looking for gold ETFs like GLD? Does this long-term create an opportunity for traders and investors to position their portfolio into accumulating gold?
Sharp question, sir. And it hits on something we actually analyzed over on our daily news page just a few days ago in our market updates. To look closely at the numbers, seeing gold pull back toward that $4,013 mark right after the inflation release might look scary, but as fundamental analysts, we see this as a totally different story. For long-term investors, especially our listeners who aren't looking to take big risks trading complex futures contracts, this drop is a phenomenal opportunity to get in. Think of a simple exchange-traded fund like the GLD ETF as an easy, stress-free way to buy into gold. It allows you to own a piece of real, physically backed gold without the massive headache of having to buy and store heavy metal bars yourself. And I think what's really driving this price drop behind the scenes is a huge scramble for cash by big institutional investors. See, On top of the strong US economic fundamentals and the talk of the Fed keeping interest rates high, we also have the massive SpaceX IPO happening right now. To get enough cash to buy into this highly anticipated SpaceX IPO, major investment funds are actively liquidating and selling off some of their easiest to trade holdings, and that includes trimming their big tech stocks and even dumping their gold. So, when big funds dump gold just to raise quick cash for an IPO, it creates an artificial dip in the price. The long term reality of sticky inflation at 4.2% hasn't changed at all. Using a temporary drop like this to steadily build a long term position through an ETF is a highly disciplined move. It lets you buy a great financial insurance policy for your portfolio at a relative discount, which is exactly how you build real wealth over time. Nothing more, nothing less.
SpaceX. Look, for people that will be looking into buying SpaceX during IPO, they should look into that. But I think on episode 3 or 4, we did discuss the idea of not getting involved in the IPO date of companies, because sometimes after IPOs, the companies tend to trade lower than the IPO price. But anyway, Kevin, I want to ask you something. Most of our listeners are puzzled by the current move of gold, because most retail traders and retail investors have been told that gold is a safe haven asset and it's a hedge against inflation. But lately, we have seen an active war, we have seen rising inflation, yet the gold price is still under pressure and it's moving lower. Can you please explain why is gold in this environment moving lower, and help us reframe what the term safe haven means in today's financial market conditions?
I mean, you've just highlighted one of the biggest misconceptions in retail trading. It's a classic paradox. Retail investors are always told that gold is a safe haven and a hedge against inflation. So when they see an active war and rising inflation, they expect gold to skyrocket. When it falls instead, they get incredibly confused. But we have to reframe what safe haven actually means in today's market. Gold is an asset that pays exactly 0% interest. When the inflation number prints high at 4.2% and payrolls come in hot, the market immediately realizes that the Federal Reserve will keep interest rates elevated for much longer to fight that inflation. When interest rates stay high or go higher, short term US government bonds start paying a guaranteed, incredibly high return. Large institutional money managers look at that and think, why should I hold billions in gold that pays me nothing when I can get a massive guaranteed return in US government bonds? Um, on top of that, you have to look at what's happening behind the scenes with liquidity. Right now, a lot of large institutional investors are actually dumping their gold holdings for hard cash because they need the money to fund their entries into the massive SpaceX IPO. So, between the strong US economic fundamentals keeping interest rates high and big funds selling off gold to raise cash for the SpaceX IPO, the price is facing a lot of short term pressure. The term safe haven doesn't mean an asset is a magical shield that goes up every single day there's a bad headline. It means it holds its long term value over a multi year cycle when paper currencies are losing their purchasing power. The current sell off isn't a failure of gold, it's just a mechanical reaction to a stronger dollar, higher yields, and an institutional scramble for cash.
I think, oh wow, beautiful. I think you have re-answered the question, the second question that I asked, and this question broadly together. That's a perfect answer. I think we'll learn a lot from you. And I think if the retail traders and investors can take their mind out of the idea that gold is a safe haven at all time, I think basically we could benefit from that, and also to look into government bonds. Doesn't have to be the US government bonds. Even here in South Africa, you could look into South African government bonds when inflation is high. And currently, we have seen South African Reserve Bank increase rates, which makes our bond attractive. But anyway, earlier on we touched on micro data affecting markets. The Nasdaq price has been under pressure since NFP and CPI release, but I want to broaden this beyond just Nasdaq and S&P 500. Why are the equities broadly under pressure right now? What is the connection between micro numbers and the price sell-off across all equity globally? Just give me a thought.
Okay, look, I mean, it's easy to focus just on the tech sector, but the reality is that the entire global stock market is taking a hit right now. And it all ties back to the exact same macroeconomic thread we've been pulling on. We actually mapped out this entire global domino effect on our daily news page over at CTA Research.Africa right after the jobs data dropped. The core connection here comes down to a basic finance rule. The risk-free rate of return, when macro numbers like the NFP and CPI come in as hot as they did, it forces government bond yields to jump up fast. Okay, so if you can suddenly lock in a guaranteed, highly attractive return on a US government bond because the Fed interest rate hike outlook is tightening, the hurdle for every other asset on the planet instantly goes up. Think of it as a giant financial vacuum cleaner. High interest rates and strong US fundamentals suck cash right out of global stock markets and pull that money back into the safety of debt markets. Furthermore, when inflation remains sticky and interest rates stay high, it acts as a direct tax on future corporate profits by raising borrowing costs and slowing down consumer spending. On top of all that macro weight, you have to look at the massive technical pressure from the historic SpaceX IPO that just hit the market on Friday, June 12th. Big institutional funds didn't just have an extra $75 billion lying around to buy into the biggest IPO in history. They had to aggressively liquidate their existing holdings, selling off global equities, and even dumping gold just to raise the hard cash needed to fund their pieces of that deal. On its first day of trading, SpaceX popped from its fixed IPO price of $135 all the way to a closing price of around $161, pushing its total valuation above $2.1 trillion. When you have macro gravity pulling down valuations at the exact same time, institutional money is being drained out of the broader market to chase a historic debut like that, global stock prices are naturally going to hit the floor.
I'm glad you have touched on SpaceX and its movement from the IPO time until closure. And you know what they say in the financial market commentary, Elon Musk has created a lot of millionaires. But anyway, I want to be specific into major mega cap companies that are under significant pressure. One of them is Amazon, which is trading at $237 at close. Microsoft is trading at approximately $397, down from $470 since the 1st of June, which is down roughly about 16% in just 11 days. My question is this: are mega cap companies rate sensitive, or is this a weak fundamentals that we see in these companies, or that might be happening in the two companies that I just mentioned, or this is purely micro-driven move? And I think the reason I'm asking this important question, and this I think also our listeners will want to benefit from them, because as I said before, most of our listeners are retail traders. We've been told again that rate sensitive stocks are mid cap and small cap companies. But in this case, we have seen Russell, which is down about 4%, and Nasdaq is down 8%. And when you look at the two, Russell, it's small to mid cap stocks, while Nasdaq is mega cap stocks. But it seems like Nasdaq is being hit more, or it's being hit harder. But anyway, please, can you help us understand this scenario and what's happening?
Man, this is honestly the golden question of this entire market cycle. And it's something we've been debating looking at our latest equity tracking dashboard. Most retail investors have been fed this textbook narrative that mega caps are safe and only small caps in the Russell 2000 are rate sensitive. So, seeing Microsoft drop about 16% in just 11 days since the 1st of June is a massive wake up call. And And to answer you directly, this is absolutely a macro-driven valuation move, not a breakdown in their core business fundamentals. What's happening here is a classic case of hidden duration risk mixed with that absolute scramble for institutional liquidity we just spoke about. Because their projected massive profits are further out in the future, these mega caps are mathematically highly sensitive to changes in long-term interest rates. When the NFP and CPI numbers suddenly reality check the market, all those assumed rate cuts vanish. If you discount a company's future cash flows by a much higher interest rate, the current fair value of that stock drops instantly. And because their valuations were stretched so tightly to perfection, they have a lot further to fall than the small caps, which were already trading at depressed levels. But there is a huge contrarian layer here that the mainstream media isn't talking about, and it's the sheer force feeding of this SpaceX IPO down the market's throat. Traditional Nasdaq rules always require a stock to have at least a year of seasoning and a minimum 10% public float before getting anywhere near the flagship index. But Nasdaq literally changed its rules effective May 1st, completely eliminating that minimum float rule and introducing a 15-day fast entry just to accommodate SpaceX. So, from a fundamental perspective, we are highly skeptical. If you look past the hype, the core fundamentals aren't actually impressive. The business carries massive debt, heavily relies on a promise of the distant future, and represents a massive bet on a single founder, Elon Musk, who, by the way, has set things up so that investors can't even vote him out. Normal companies go through strict vetting, but this was rushed through a 15-day window, creating a massive forced demand where index trackers have to dump high quality, cash generative companies like Microsoft or Amazon just to make room for it. So while Amazon closing around $237 and Microsoft finishing around $397 looks bad, their core businesses are rock solid. They are simply being sold off to feed a highly debt laden corporate governance nightmare because the rules were bent to force people to own it. It's a valuation reset driven by bent rules and forced capital reallocation, pure and simple.
I think I wouldn't wanna mess up what you just said now, and I think to all our listeners, for you just to have a glimpse and understand the market on a daily basis, please check out CTA Research.Africa on their daily newsletters. Just check out they do this all this analysis and explain the market without the noise of financial commentary, but only looking at their commentary. I think CTA Research.Africa news page, it's perfect for you. And I think if you do that every single day in the morning, midday, this is according to me, in the morning, midday, and towards the JSE close or towards the New York close, I think you'll benefit greatly from that. Finally, before we close it off, I'm going to bring everything together, given that all the equities or global markets are under pressure, more especially equities. Is this move creating a genuine opportunity for traders and investors to buy quality stock at a lower price with a better risk to reward ratio, or with a better risk to reward, given the fact that stocks will be much cheaper? There's still a lot of upside move that the stock will basically in turn provide that gives a better risk to reward. On the JSE specifically, the reason for my questions and why I'm phrasing these questions like this, you have seen the South African top 40 index is down 16% from its top. We have seen the real estate investment trust ETF is down 10% since February. The Cetrix capped ND ETF is down approximately 12% since November 2025. Using this as an example, does this picture tell us that the JSE is broadly under pressure with limited growth, or what should South African retail investors be thinking about in this current environment? Because it looks if you move out and look at the broader market in the JSE, you'll think the Johannesburg Stock Exchange is under a lot of pressure. Just give us and assist us to understand if this will provide better risk to reward, or this is definitely the JSE under pressure.
Look, Now, bringing everything we've spoken about together, from the sticky CPI numbers to the mechanical liquidity drain from the SpaceX IPO, I absolutely believe these aggressive pullbacks are opening up genuine, high conviction opportunities for disciplined investors. When macro panic and forced institutional index rotations hit the market, big funds often throw the baby out with the bathwater, which means you get to buy incredible cash flush businesses at a massive structural discount. When you have a situation where index providers bend the knee and change their historical frameworks to fast track an IPO with weak current fundamentals and zero investor voting power, it tells you how distorted the broader market averages can get. Now, when you look at the JSE specifically, with the SA40 down 16%, the real estate ETF down 10%, and the Satrix kept Indie ETF down roughly 12% since November 2025. It's easy for retail investors to look at those charts and assume our local market is completely broken with limited growth. But as fundamental analysts, we know that an index is just an average. Beneath the surface of a depressed index, there are individual, highly insulated companies with exceptional pricing power that are completely bucking the trend. If you want to see exactly how we analyze these local opportunities, we actually just published an extensive breakdown on our daily news page. And right now, South African retail investors shouldn't be panicking or fleeing the market to chase overhyped, unvetted global listings that were rushed to the market in 15 days. They should be shifting away from speculative, highly indebted companies and focusing entirely on high quality, cash generative safe havens right here. It's about moving from quantity to high conviction quality. Thank you so much for having me on this episode, my good sir. To everyone tuning in, don't let the short term macro noise or the forced hype of index reweightings shake you out of your long term goals. Stay disciplined, always manage your risk, and come join our analyst community over at CTA Research.Africa to start building your trading edge today.
I wouldn't have said it much better than you did, Kevin. I think, and I'll emphasize this over and over again, and I think in this episode I did that a lot. Please, guys, search CTA Research.Africa. Look out for their daily news breakdowns and market analysis. You'll benefit a lot from that, and you'll understand the market's movement and where the market is going next. Thank you so much, Kevin, for joining me. I truly appreciate that. Do not forget to go to ctaresearch.africa. I know I'm saying that again and again. And do not forget to like and subscribe. Subscribe on YouTube, subscribe on TikTok, and do not forget to engage with our content. Leave a comment, tell us what you think, and if you have any questions, just on the comment section, just leave a question. I'll be happy to ask Charles or Kevin on our next episode. I'll truly appreciate that, and thank you so much, guys. Have a great day. Nzakenza.